Seizure right there from the customs. All right, let's head on to our first conversation now. We're looking at the latest data from the Central Bank of Nigeria when it comes to money supply and other matters in the commodities market. Ralph Jumabi Oluwole is a researcher, research manager at Financial Directors Company. Great to have you on the show, Jumabi. Good morning.
Having me.
Yeah, so we see money supply, or M3, that accelerated to about 8.39% year on year in May from 4.83% in April. What factors are driving this sharp increase? Do you think we should be seeing an increase, at this point?
From the numbers, we've seen that net foreign assets, net domestic assets, both increased, supporting the jump that we saw in broad money supply. And not only broad money supply, that is M3 increase, we also saw an increase in M2. So that is all money supply factors are increasing. And that means, in simple terms, what even makes up, money supply? So we're looking at currency in circulation, currency within the banks, which includes, savings, deposits, and all the likes. And more importantly, when you look at M3, you also look at, external inflows and how that is feeding the banking sector, or the money market in Nigeria. So a few things that have, supported this increase, apart from what I had mentioned, which is net foreign assets, net domestic assets. We've seen that, number one, there has been an increase in, FX inflows, primarily from crude oil, production increase, crude oil prices increase, and that of course supported the inflow of FX that supported, the net foreign asset that has, of course improved the M3 numbers. And then within the domestic economy, we've also seen like an increase in, money market activities, interbank activities, increase in treasury, fixed income activities, all of that supporting the movement in money supply. But the key thing that, of course, has remained like a big risk is how that despite, this increase in money supply, lending to the private sector, did not improve. And of course, that makes sense when you consider that lending rates have been, significantly high due to the fact that the Monetary Policy Authority, the central bank, has left, interest rates higher for longer to curtail price pressures in the economy. So I would say that puts together the summary for the money supply increase.
Right, and definitely we'd like to see more credit to the private, sector. But, given CBN's tight monetary policy stance, should we be surprised, that it's actually increasing, that's money supply?
When you consider the factors that have driven it, not so much. I know the idea a lot of times behind it is, that means a lot of money is moving around. There's cash, there's a lot of cash in the economy, but it's not only cash that money
the average man on the street will say, why is the money not coming to me? Money supply is increasing, but it's not in my pocket.
Exactly. So that's why, I kind of try to segregate or really go further in explaining the components of money supply and what exactly has driven this increase. So it's not only like cash in circulation. If not, it will be more around, oh my God, there's a lot of cash. So why am I not having cash in my own hand? Why can't I spend as much? And why am I saying that money supply is increasing? So there are other factors that have contributed to this increase. But I think it's also important that we also check the fact that cash in circulation did not necessarily jump as much, and that of course necessarily points to the fact that we're seeing an increase in the adoption of e-channels, with the fact that insecurity is also on the rise. We're seeing more people, adopt using the banks. The fact that we're also seeing like more friendly payment systems where you have POS merchants here and there that are easy to access for, rural communities, smaller business owners. It has become easier to access the formal financial market. And when you even look at the NIBS data, you see the movement of POS transactions, you see the movement of transfer transactions. You realize that, okay, a lot of individuals are beginning to adopt these channels more, and so that in itself is supporting the slowdown thereabout in cash in circulation. And more importantly, it also points to the fact that money supply right now is not the biggest driver of inflation in Nigeria today. The simple definition of inflation is too much money chasing too few goods, and right now that's really not the case in Nigeria. The the increase in money supply is not directly proportionate to the increase in inflation. So there are other factors that are driving inflation in Nigeria today, and consequently the squeeze in income levels for consumers and broadly households. And there we now start looking at the fiscal aspects, the supply chain factors, the insecurity factor, the agri productivity factors, all of which that continue to drive inflation in Nigeria.
Right, and looking at money supply still rising, does that mean we can't expect inflation to actually drop in the near term?
Well, I again, like I mentioned, there are other factors, driving inflation right now. So not because money supply might not have an impact, but its impact is not as much, to significantly nudge the decision to either cut rates or drive inflation exponentially, higher. And that's exactly why understanding the components of money supply right now today is extremely important. And from the beginning of the conversation, we've been able to establish the fact that what necessarily is driving this increase in net foreign assets or net domestic assets are primarily increase in FX inflows, increase in FX inflows from external factors, increase in trade activities. And then in domestic market, we're seeing more interbank activities, not necessarily too much money within the, within the Nigerian demand side, the demand side of the economy that would be driving inflation. But I also think that it's important to still note, I do believe that the central bank would definitely consider it as a factor. But I guess the major thing that I really want to, emphasize on in the conversation today is that monetary, factors right now are less, of a driver of inflation than the supply side factors, which are really within the purview of fiscal authorities to resolve. And we know these factors, right? Insecurity that is significantly affecting, the ability of farmers to get into their farms, produce, and then, increase food supply, which ideally we still know is a major driver of, inflation today. You also consider the logistics cost, petrol prices, even though, of course, we're in a different market where global forces and other market forces determine the price of petrol prices, but not until we improve our own refining capacity that we begin to see a significant decline or at least some stability in petrol prices that continues to increase logistics costs, supply chain costs, and of course again impact inflation. Because on the monetary side, money supply, despite the fact they're increasing, the main drivers are well contained. And then on the FX side, we're also seeing some stability. So I will say the monetary policy side is somewhat in check.
All right. So we see private sector credits, that's dropping. But government borrowing, that's risen so far. Definitely not the kind of, not how you'd like, your economy to run. But how can we make lemonade from this?
I like the scenario you put here because ideally it's a bittersweet situation. So lemonade is not all sweet.
All right.
But I think that we do have some bright spots, and I do think that there are some policy changes that that can be made. But again, I also want to emphasize that it's not so much on the power of the central bank, because their responsibility is to ensure price stability, and that primarily revolves around inflation and exchange rates, right? So, and they are doing their part. On the government borrowing side, the logic behind it is not too far-fetched when you consider that the government is also trying to not increase their exposure to global interest rates or foreign currency pressures, right? So they have leveraged more on borrowing domestically. While this of course raises the risk for crowding out private sector, to some extent it reduces the external repayment risks that the country could face later on. On the business side, I do think that there might be some concessions that could be made, and some of these things are already happening. For instance, the gazetting of the AFCTA, tariff, to ensure that local businesses can export their materials outside of Nigeria within other African countries. At a cost that is, very bearable. Domestically, I do think that some of these concessions also need to be made when you consider that there are smaller business owners, and concessions around, power, concessions around logistics costs. And maybe I do bodies and institutions like the Manufacturing Association of Nigeria, the agricultural bodies, I think those conversations need to happen a lot more to ensure that there is streamlined communication and policy incentives that benefit all parties, so that we don't see, more labor market disruptions like strikes and all of that across the nation. So again, I do think that there's a lot more work to be done on the fiscal side than more on the monetary side. But communication in itself, in my opinion, across both bodies, which is both fiscal and monetary, I think it's still extremely important. A lot of business owners and individuals do not really understand the technicalities of monetary policy and why the central bank is not just helping us remove inflation from, what it's from about 15% to just zero. Just tell everybody that inflation is now down, So people need to understand the reason why that's happening, and maybe more non-technical communication needs to happen across the board. And on the fiscal side, I think that a lot more work needs to happen across from the federal government to the MDAs to the local government bodies. There seems to be some level of dissonance in how communication happens across there, and that continues to widen the trust deficit between the people and the government. And I think until that is addressed, all of these issues will still remain.
All right, let's pivot to the oil markets now. We're still seeing the drops continue. At this point, the shorts are still winning. From last week, into this week, WTI sub $70 per barrel. At this point, do we see more drops coming today?
I mean, yes, I do. I think when I had a conversation with you on Tuesday, we did speak about possibility of oil prices falling further to around $70 per barrel, and I think that that's going to be the case, and if not even lower. The main thing here is that there's now an increase in supply, right? That is nudging this price decline, and the expectation is that it would likely continue, right? So I think that we would see more declines in the oil market as long as the US-Iran talks continue to progress positively. The Strait of Hormuz remains reopened. I think that would continually support the decline in oil prices. And of course, when we bring that to the domestic market, we should likely see the NNPC and Dangote Refinery continue to reduce prices to ensure that domestic market enjoys the benefit of the reduction in global oil prices. That should somewhat alleviate some of the pressures we've seen on logistics and distribution costs, and maybe to some extent to food prices, even though for food prices we still see more pressure around insecurity issues that are nudging more, that are stoking food inflation right now. The other thing to consider here is the change in the monetary policy environment, right? So globally, we would likely see global central banks like the ECB, the Bank of England, the US Fed begin to take more. They will remain cautious, but I do believe that we could start hearing more conversations around them, maybe resuming their rate cutting cycle if downward pressure on prices persist, especially with energy costs and then food costs. So I think that that conversation now is back on the table, and if we see them lead in that direction, we might see African central banks follow suit, and maybe the Central Bank of Nigeria also follow suit. But again, there might be some lag before we see the central bank cut rates, simply because the inflation rate in Nigeria, while it's better than where we were some years ago and even a few months ago, I think that the central bank will still remain very orthodox in how it approaches cutting rates, especially to keep investor sentiments and investor confidence positive.
Right. And maybe talking about lag at this point, remember when the Iran war, started, oil prices started, shooting up, crossed $100 per barrel. The speed at which fuel prices rose, I still can't fathom it, but it's not that fast, even though prices are dropping so fast. Even President Trump is worried.
Interestingly, I knew where your question was headed before you even landed. I think we have seen, I'll point to two things here. The first one is uncertainty, right? While the global markets, typically react very quickly to when price increases and even before now when prices fall, because we're now in a different, ecosystem in geopolitics where today the market could look stable and tomorrow things change very drastically. So I will say that that level of uncertainty, the markets are heavily pricing it in so that they don't take too much of a big bet on prices significantly falling and then it becomes a problem later on. Everyone wants to hedge as much as possible. So I think that's definitely the case, and that's why we're seeing this happen.
Right.
More importantly, the level at which we're seeing, new vessels exiting the Strait of Hormuz. I mean, remember, it's not as fast, right? So until that conversation and that progress significantly increases, we wouldn't see prices drop significantly, and it will be the same in Nigeria as well.
Right. I guess when prices of oil rise fast, we don't really care much about hedging, but when the prices come down, we want to hedge to make sure it's really coming down at this point. Thank you so much. Dumebi Oluwole, Manager for Research at Financial Directors Company. Thank you so much.
Thank you for having me.
All right, we'll take a break now. When we come back, more issues around Nigeria's energy sector. That's in a moment. Just stay with us.